Daniel here, General Concepts. Wanted to cover a little more. This is kind of a continuation of an older video that I did on section 7702 of the IRS code. So this code, whenever I talked about it before, it had to do with they were making some changes and the insurance company were making changes, and it actually lets you put more money into a life insurance policy than you used to before based on what they call a 7-pay test. 7-pay test basically says there's a certain amount you can pay in for 7 years and you can't exceed that amount, or it becomes a modified endowment contract. And that's a simple way of putting it. But with that being said, you are able to put more with less death benefit, where before you had to have more death benefit than you did previously. So now you're able to, for lack of a better word, cram more money into the policy than you used to be able to. Now that was, I explained that in a previous video. In general, 7702 covers permanent life insurance, cash value life insurance. So if it has a cash value, it explains the guidelines of what a modified endowment contract is and why it would become a modified endowment contract, meaning that it's basically a life insurance policy, but it's taxable. So you access the money, it doesn't matter if it's a loan, if it's, by any other means, withdrawal or anything else, any gains are directly taxable. Now, don't get me wrong, in a regular life insurance policy, technically they're tax deferred, which is kind of strange because whenever you talk about the dividends that you receive, they consider it what's called a return of premium, which means that it's a return of what you've paid in. It doesn't really, in my opinion, isn't a good definition for it, but it keeps you basically from having to pay taxes. 1, 2, if you access it right, you're never going to pay taxes on that money anyway. So it doesn't matter because you can access that money by either taking withdrawals up to the cost basis, meaning the cost basis is the amount you've paid in. So if you were putting in, let's just say, what you would normally put into some of these retirement situations. So let's just say you put in $500 a month, $6,000 a year. You can put much more than that because with insurance, that's the nice thing about it, is you can put a lot more money in there. The IRS still limits you in a way, but it doesn't limit you in the way that the only limiting factor is going to be possibly, and that's if you get into really higher amounts, is your income and or your net worth. Only limiting factors. The insurance company's not going to let you over-insure yourself. But the flip side of that is that if you're doing, for example, be your own banker type of situation, each policy that you put in force that you have cash accumulation in, that adds to your net worth. So as you add more and more policies and you're cramming more and more money into these things, your net worth goes up because it's a tier 1 savings asset. So, and so you can take withdrawals up to I'm getting off track, but you can take withdrawals up to your cost basis and then take loans from there on. And usually with most of these life insurance policies, once you hit it depends on the insurance company, but a lot of them, whenever you hit a certain age or a certain amount of policy years, they drop the interest rate down. And even if they don't, in a lot of cases, it's simple interest. So it's not, it's still going to work out in your favor. These are used for retirement all the time. And so a lot of people will make these part of their portfolio. They'll have their stocks, and then they'll have their retirement accounts, and then they will have cash value life insurance. But going back to 7702, it basically gives you the tax advantages that's covered because of the fact that it is a life insurance policy. It's not considered an investment. So the difference is back many years back, before they put this guideline in place, was that a lot of wealthy people would put as much as they could into it without limits, and they would just put it in there and never have to pay taxes again after they paid their initial tax on the money. So you're putting in the after-tax dollars, and then you're not. It's I won't say it's the equivalent because they're not the same, but it's kind of the same thought process of you're using after-tax dollars for like a Roth IRA or a Roth 401k type of thing, the Roth vehicles. And then the growth is supposed to be returned to you without having to pay taxes on it. And this is a little bit different situation, but the nice thing is you can have all of that. You can have your future money without having to pay additional taxes on it. So anyway, that's kind of the general idea on 7702. It basically lays out the guidelines for whether or not it's taxable, whether, they talk about either a guideline premium test or the 7-pay test, which is just, they're slightly different, but they're ways of making sure that it fits one of their guidelines and it's not being a normal taxable vehicle. And maybe a vehicle isn't, or contract, I should say, in this situation. So anyway, that's 7702. I might have left out a few details, but nothing that would, without getting too deep into it and boring you to death. That's pretty much it. So please like, subscribe, hit the notification bell. And then if there's anything that you want to hear about, if there's anything I left out that you had questions about, or maybe there's something I just said that you had questions about, put it down below in the comments. Always glad to interact and carry on the conversation. And you can also reach out and get on my calendar under the genwealthconcepts.com/contact link down below. Have a good one.